thinking about some of these big events like wildfires and hurricanes or ice storms, they aren't consistent every year. They're really lumpy. So you have to think about, okay, what's going to happen and how bad is it going to be? So let me go through some simple math of investing in resilience. And we want to wind up thinking about how some of your companies do this. So in terms of investing in resilience, simple definition for today. I mean, there's many definitions and people have built careers on this, but resilient infrastructure able to withstand and bounce back from shocks, including these kind of things: weather, economy, public health, capital markets, politics, just a simple list of things to be able to bounce back from. So what would cash flow look like for an investment in resilience? So there are three kind of easy scenarios here. Almost everything in finance, simple scenarios. Almost everything in finance is like, compared to what other choice? Like, is 7% a good return? I don't know, compared to what? So you have to look at other choices around investing in resilience as well. So cash flow A, there's no resilience investment and no bad event happens. Like, imagine this is a power plant that might be in the path of either wildfire or tsunami or something like that. So the baseline investment here is $20 million, red going out. There's no additional resilience investment. Cash flow for operations is $20 million a year, good investment, 100% cash on cost return. After 4 years, there's $80 million. There's no stress event. Everybody's happy. This is really cool. So you see where this is going, right? Scenario B is there's no resilience investment and a bad thing happens. So the baseline investment is 20 out. There's no additional resilience investment. So far, a lot of these discussions about hardening and resilience sort of assume that we're going to protect every asset at infinite cost forever, which is really not that realistic. So homeowners have to decide, businesses have to decide, governments have to decide, society has to decide what to do with these various things.
Well, several things are missing. There's no probabilities built in so that we could factor the expected returns. Cost of capital has been mentioned. And you could also look at past experience, history, what's happened and what kind of trends are occurring, so that you get a dynamic model instead of just a static comparison.
Everything in resilience finance, in my view, is a matter of probabilities. That's why I asked Charles to draw this out. There are lots of scenarios, they vary by location. So this is Boston, this is sea level rise in Boston. And this is derived from the IPCC curves that I'm sure Dan talked about. And this is from an Urban Land Institute project that I worked on. I'm a member of ULI because I'm a real estate guy. And these are different possible scenarios. So the highest one is 2 meters or 6.5 feet taller than I am of sea level rise by 2100 in Boston. The lowest one is maybe half a foot. That's a huge difference. Nobody knows. These are probabilities. It may change some and it gets updated, but it's not like the sea's going up 6 feet tomorrow. It's also, and maybe you'll see it go backwards. And if you think the sea's going to go down, great. I'll take the other side of that trade, but you can put that in the probability model. So there are several issues here that make it hard for investments to really get made. One is that the probability of what this rise is going to be is unknown. I mean, it gets closer and closer in time, I guess. The second is, when does it happen? That's also unknown. So we don't know the time frame, but we're only in 2021 right now. And as you can imagine, the third arrow I'm going to put in here is the investment horizon. So for most financial investors not in public utilities, the time horizon might be 7 to 10 years. Look how little this curve changes in 7 to 10 years. So you have to think that there's some difference in storms, not just in sea level rise, to rationalize doing anything in the 7 to 10 year time frame, particularly if your cost of capital is high. So Tafosa brought up the cost of capital issue. If your cost of capital issue is zero, these things lay out well. If your cost of capital is 15% from some private equity person, they're going to build this office building, rent it up, and get out of town before something happens, is their hope. So that's one probability that needs to come into the equation. And you can model these things dynamically, as Charles says, with different probabilities, just based on what you believe. The second probability curve that is discussed a lot is around an exceedance probability curve. This is how insurance companies think. They essentially think, how bad can it be and how likely is it to happen? Over here, we're saying, how likely is this to occur? What's the probability? What's the size of the loss? So the likelihood of a really big loss is relatively small. So way out here on the far right is sort of one of these black swan kind of things. You have a big loss, but it's probably not going to happen. And up here is a smaller loss is more likely to happen. A lot of what gets talked about in investing in resilience is how do you move this curve? How do you shift this curve? So if we have more time, I'd also draw this out with you, but essentially, if we can make investments either in locating facilities or in reinforcing facilities or thinking about cities and seawalls or drainage or whatever it is, that make either the probability of occurrence lower or the loss less, then we move the curve in this kind of direction to the bottom left, and that's beneficial compared to before. On the other hand, if we think that climate is going to increase the probabilities of some of these things happening, then it winds up looking worse. So part of the game is what can we physically do in the assets, part's what you think is going to happen. So using climate models, you can combine these two things. You can generate an exceedance curve for any of the points on the IPCC sea level rise curves in any location in the world using these two probabilities.
Risk-based approach makes all the sense in the world. I mean, you have to look at something, particularly over a long time horizon, and calculate the risks, right, based into it. You have to look at the long-term outcomes and not just the near-term outcomes. It's not if the event happens; the event's going to happen. It's a matter of what is the consequence when the event happens, and I think it's catastrophic. And I don't know how you even recover from it if that event really does occur. Ultimately, like all models, it is an input into decision making. It's not necessarily the decision in and of itself. Yeah. And you have to look at both the quantitative and the qualitative, situation.
And this was mentioned earlier about moving away from some of these areas. Like, why are we allowing people to build in harm's way here? So this is a very American thing to do, to say you can build anywhere you want, and then the government will come bail you out, maybe. Or you can plan to rebuild, which is by far the market leader. And as it is pretty clear to a lot of folks, if you expect that FEMA or the United Nations or somebody is going to ride to the rescue afterwards, you basically, Robert Savins would say you privatize the gains and socialize the losses. You expect someone else to ride to the rescue. Is that not everybody has the same information. So there are a lot of investment opportunities from different information. Climate intelligence, arms race, and financial firms. This means that people are buying different projections and making bets on it. Climate risk and real estate investment decision by Heitman. You can see here where Moody's, the rating system, acquired 427, which is an artificial intelligence-based climate model. They're selling proprietary information to Moody's clients, not to me. They know more about my house than I do. Are we on the verge of another financial crisis? This is a piece I wrote last month, 2 months ago in the Harvard Business Review, thinking of this disproportionate information, impacts on mortgages, impacts on Fannie Mae and Freddie Mac, impacts on municipal bonds, and how this might flow through again. So I want you to think about these things as you go forth and think about, as homeowners and policymakers, what you would do.